very good morning to you all for the latest in the series of Skybound Capital webinars as we continue lockdown all over the world due to the COVID-19 pandemic. But as we're seeing around the world, slowly but surely, certain economies are starting to get their wheels turning again. This webinar is co-hosted by Skybound Capital and GMG Real Estate, who have had a long-standing relationship. My name is Matthew Pierce, and I'm delighted to say that I am back in the office, in the Cape Town offices of Skybound Capital. We can welcome our staff from all around the world, from Hong Kong, London, Australia, Mauritius. We also have a number of our clients, IFAs involved in the call, and thank you for registering and continuing to make these webinars popular. I am fully compliant. I have my mask. I won't be applying it for the duration of the webinar because I am in isolation in my office on the 8th floor of our building here in Cape Town. So lovely to have you all with us here today. And it's my pleasure to be able to introduce you to various members of the GMG Real Estate team. And our theme today is around the COVID impact on property management. I think a lot has been written about and spoken about with regards to the effect on both commercial and residential property during this time and how businesses are going to emerge. And we thought it was the perfect opportunity to introduce you to the GMG Real Estate team. And no better place to start than with the Chief Executive Officer, Newman Leach, who joins us from Switzerland today. And Newman, as always, great to see you on screen. And I think the perfect place to start for the benefit of our attendees, perhaps not familiar with GMG Real Estate, if you can give us a brief introduction to your background and your operations.
Well, firstly, good morning, Matt. It's a pleasure to be given the opportunity to present, and thank you and to the rest of the Skybound team for arranging this webinar. My name is Newman, for those of you who don't know. I'm a co-founder of Geneva Management Group. We set up GMG Real Estate back in 2005. I'm originally South African. I did a BCom LLB at the University of the Witwatersrand back in the day, in the late 80s, early 90s. I moved to Switzerland in 98, met Dave Alsace in 99, and we set up Geneva Management Group in February of 2000. We set up a real estate business in 2005, which today is GMG Real Estate. In terms of the activity of the company, GMG Real Estate is a private investments and development company specializing in the acquisition, development, and asset management of real estate. We try and identify projects where we are able to deliver superior returns to our investors and to ourselves, because we co-invest in all our projects ourselves. Our investment ambit is fully encompassing in that we source the opportunities ourselves, we due diligence the opportunities, we take full responsibility for the raising of the capital, both equity and debt, and we de-risk the opportunities in various ways, principally by way of planning, rezoning, increasing massing, and we take responsibility for the construction and ultimately an exit at the appropriate time. Across all our offices, we have a full spectrum of professionals, asset managers, project managers, analysts, as well as a finance and legal team. As such, in each office, we are able to deal with a full spectrum of the investment cycle and manage the projects in country without the need for cross-border travel, which talks to what's happened in COVID recently. In terms of markets, we focus on 4 principal jurisdictions. We've got projects in the United Kingdom, Portugal, Switzerland, and Germany, with offices in all those jurisdictions, with a satellite office that we recently set up in Berlin. I think at the core of our USP, our value, is the fact that we act as a lead investor, and in that capacity invest in the projects ourselves. We therefore have clear skin in the game and seek co-investors across all our projects. We also act as general partner, taking the full responsibility for the development and exit of each asset. Since we set up the company in 2005, we've transacted on over 30 projects with a combined asset value well north of €1 billion equivalent. We currently manage 600 million euro of assets, euro equivalent, because we've got assets in Switzerland as well as the United Kingdom. and that's spread across 13 projects.
So Newman, tell us a bit more, if you can, about the relationship between GMG Real Estate and Skybound Capital, how it came about and how it's developed.
Well, I've known Clifford for a number of years, probably for the better half of 20 years that I've been in Switzerland. I knew Clifford prior to the setup of the Prism Fund, but it was really the setup of the Prism Fund that gave us an opportunity to work together. A bit of background: prior to the setup of the Prism Fund, from 2005 through to around 2015, the core focus of the real estate team was looking mostly at fixed income assets, and as a result, the capital structure of debt and equity didn't really accommodate any mezzanine or bridge financing in the model. Around 2015, we changed that methodology, or the investment focus, to more value add projects, and that really facilitated the need for mezzanine and bridge financing, which of course is where Skybound play a huge part in our investment cycle, and that really was the catalyst for us being able to work together. So,
you mentioned in your opening statements around how you have experts in each territory in which you operate, and that has been a wonderful mitigating factor for you against some of the effects of the current scenario we find ourselves in. But can you expand a little bit more around how COVID-19 has affected the business and the sector in general?
Well, across all our offices, we've been in various stages of lockdown. I'm back at work now in Switzerland. Departments have been in the office for a couple of weeks. Staff aren't back yet. And I think that's the same scenario across all our offices: London, Lisbon. And in terms of the day-to-day reality, the majority of our projects are due for delivery 2021 to 2023. So in reality, across the 13 projects, we only had enabling works occurring on one project, which did not stop. And we had we had full construction that had already commenced on one of our projects in Lisbon. And the Portuguese government made us instill COVID procedures in terms of social distancing between the construction workers. We had to fumigate the site office twice a week. But other than that, we've had no disturbance in terms of the delivery of those projects where we were active. Had we been in full construction mode across our entire portfolio at this particular juncture, I think it would have impacted us far more seriously. But the fact that the vast majority of our portfolio is either in pre-planning, planning, or enabling works, the majority of our day-to-day interaction is with third-party consultants and professionals. So in reality, we weren't impacted materially. So we were able to continue dealing with the council on the various planning applications, dealing with the whole ambit of our professional teams, our architects, our project managers, engineers, quantity surveyors. All of that continued, albeit via Zoom. And there will be a gradual progress to go back into the office. I think in Switzerland, the staff are due to start trickling back in the next few weeks. We've yet to hear in Lisbon and in London what that exactly how the lockdown is going to be eased and broken. But I think if you look at our whole entire portfolio, we've had a minimal impact in terms of COVID. In fact, one of our projects in Lisbon, we're about to start full construction, and we've been able to finalize the contract, the tendering, and that's continued. I'd say where it has impacted us, a very small part of the portfolio involved short-term rentals, so that obviously impacted it because we dealt with a lot of tourists. And we were about to launch one of our projects in Lisbon in May, but due to the social distancing and the lockdown, we've had to push that through to September. But it's not really going to impact the timeline of our project at all.
So some positive news for you there. What I'd like to do now, we are going to take a trip around some of your professional team. We're going to go to London, and we're going to get an update from Olivia, who's in France, but around the Lisbon projects. But before we do that, if you could give us a sense, you referred in your introduction to the current value of assets under management. So if you could just give us a little bit more detail on the current AUM and the geographical spread of those assets.
With pleasure. Let me actually share a slide with you now. So if you take a look at the we've got 4 pie charts on this page. On the top left-hand side, you can see the assets under management. We've got roughly 33% of the assets in Portugal, which are all in Lisbon. The United Kingdom, all the assets are in London. We've got in Germany, we've got 1 asset, in Stuttgart, Germany, and we've got 1 industrial site in Switzerland. In the right-hand, in the pie chart on the top right-hand side, you can see the vast majority, 90% of the assets involve either full development or a value add being light refurbishment, with secured income comprising only 10% of the portfolio. If you take a look at the bottom left-hand side, you can see the assets that we recently liquidated. So 83% of our stock in Switzerland was sold in the last 36 months, with a total sales value of 370 million euro. And on the right-hand side, you can see the asset class spread that predated our sale of these assets. 73% of the assets comprised income-producing assets and 27% value add. So if you compare the bottom right pie chart with the top right pie chart, you see there's a distinct change in investment methodology, where prior to 2015, the vast majority of the assets that we acquired in the portfolio were really centered around fixed income assets versus the value add component of the portfolio today.
And Newman, just a little bit more detail, perhaps some insight into your historical returns that you've achieved on the portfolio?
I think you can stay with that slide, Simon, if you don't mind. In terms of the historical portfolio, we originally focused on fixed income assets. Maybe I'll just describe a little bit the rationale. The fixed income portfolio, the targeted return profile was between 6 and 8%, with an investment horizon of between 6 and 9 years. Value add, when we started looking at value add assets, we tended to look at a shorter investment time horizon between 3 and 5 years, with a target return of between 10 and 15%. If you look at the middle of the bottom page here, you see the historical weighted average returns. Now that's across the entire portfolio. We've managed to achieve across the portfolio an average IRR return of 25%, just under 2 times multiple, with an average holding period of about 6.6 years. Now, that's largely on account of the fact that most of the assets in the portfolio were really long-term fixed income assets, which we've now sold. Now, it's also important to bear in mind that whilst the targeted return of the fixed income assets were between 6 and 8%, if we go down to some real examples of those assets, you'll see that we've managed to achieve substantially higher returns. If you look at this page, for instance, here you've got some of the fixed income assets. On the top left-hand side, we've got the industrial headquarters of Zimmer in Dietikon outside of Zurich. This was an asset that we held for 8 years. We purchased the asset with a lease period, unbroken lease period of 15 years. We held the assets for 8 years, renegotiated that lease for a further 8 years, and sold it in the market, achieving a multiple of 2.3 times and an IRR of 15%. So phenomenal return for fixed income asset where our targeted return was 6 to 8%. Another example we can look at is on the top right-hand side. Again, fixed income assets, retail park in Germany. Very little work to do here. We had 2 key tenants. We had McDonald's and a furniture store. We held the asset for 4 years, achieved a multiple of 2.1 times and an IRR of 22%. And then the last example, if you look at the middle of the page, the Hornbach assets, that asset we held for 7 years. Hornbach, single tenant. I think this was a 30,000 square meter site in Bern, retail park, a Frankfurt listed tenant. So it was secure income, held it for 7 years, exited with a multiple of 2.1 and an IRR of 11%. So all of these examples are really fixed income assets that we purchased largely to provide a fixed income component for our investors. But as you can see, the kind of multiples that we managed to achieve were far in excess of what the original target was. Just while we're on this page, one of the other flagship assets in our portfolio on the bottom right-hand side, you can't really see the full extent of this asset, but that's the headquarters of Barclays Bank in Schönbusch in Geneva. We bought this asset in 2009. After the crisis, it was a vacant possession asset. We bought it in a dispute, and this was one of our value-add assets, just by the way. We bought the asset in a dispute between two parties. We managed to sign a 15-year lease with Barclays Bank, and we sold it just after a year, once Barclays had taken possession had taken occupation at a multiple of 3.3 times and 114% IRR. So that was one of the value-add projects in Switzerland.
Some fascinating examples there. But, Newman, before we move on to other members of the team, an interesting development relatively recently in the company's history was your partnership with New World. For the South Africans on the call, we know John Rabie extremely well. Yes. With a number of the developments he's done, especially around the Western Cape area. If you could just sum up the key points of that relatively new development.
Yes, sure, Matt. I've known John Rabie for a number of years, and we're very fortunate to be co-developing and partnering with him on some of our projects in Lisbon. John Rabie, as you know, was the founder of John Rabie Real Estate in South Africa, in the John Rabie Property Group. He also set up Signatura, and most recently New World being his offshore development arm. I met Johnny a few years ago. He came to Lisbon. We decided to co-develop Alex Living together. Him and his team have a phenomenal record of developing urban real estate, especially mixed-use urban real estate. And I think the value add he brings, him and his team, is phenomenal, and we're very grateful to be working with Johnny and his team. That partnership is now extended from one project, which is Alex Living, which Olivier will go into a little bit more detail, and is now extended to two other projects in Marvilla 1 and 2. Jointly, we're developing around 500 apartments together. We've got some retail space and some office space as well, and he has a fully fledged team in our office in Lisbon. So we're able to leverage off the expertise of both our respective team members, and I think that the final outcome and the delivery is going to be phenomenal. So we're very pleased with that partnership, and I think we're going to be partnering with Johnny and his team on many more developments, not only in Portugal but in other jurisdictions as well.
Well, Newman, thanks for that. It's a great overview to start with. We're going to go into some more specifics in just a moment. Before we go there, we're trying something else to add a bit of value to our webinars. Ross Muller, one of our colleagues here in Cape Town, is hard at work behind the scenes, and we're running some polls. We're going to run two during the course of this webinar, which Ross is going to launch a poll now, which just to have a look out for it. There you go. How long will it take for debt markets to return to pre-COVID levels of liquidity? And you get to have your input there. The host and the panelists can't vote, so we're trying to assess what you think on that question. So have a think about that, and feel free to give us your answer there. It's now my pleasure to introduce Simon Banks, who's head of real estate in London for GMG Real Estate. Simon is joining us from London today. Simon, great to have you on the webinar. And as we start drilling down more into the GMG Real Estate portfolio, perhaps the best place to start is with what you consider to be your flagship projects currently in London.
Yeah, good morning, everybody. I'll just talk you through our main two projects in London at the moment, which I think really fit with GMG's philosophy of investing in real estate with a strong cultural and historical identity in strong submarkets in London that are close to major transport hubs. And both of these assets are historically significant assets where we can really add a lot of value by increasing the massing, the overall scale of the sites through our expertise in the town planning system. I'll just talk you through our first project, which is in Clerkenwell, which is a submarket just north of the City Square Mile. It's a sub-market we really like because it's got a lot of historical connections. It's littered with conservation areas. The buildings generally are filled with a lot of character. And Clerkenwell itself has more creative space per square mile than any other sub-market in the world, actually. So, you know, it really resonates with the strength of the technology and media sectors in London and their demand for interesting buildings. So the site on the screen there, you can see edged red, and it really shows you that you know, there's a lot of underutilization in the existing site. We've got an existing building, which is actually a former Victorian school building, and inspired many Charles Dickens novels. So it has a lot of historical value, which resonates strongly with occupiers and investors. Indeed, some of the Oliver Twist scenes were filmed in this building. So we are retaining that building and converting it into inspirational office space, really taking advantage of the raw materials and the character of the building. And the rest of the site, which is a disused car park and some smaller outbuildings, we are developing out a new 153-bedroom hotel building, which we have pre-let to a German operator. So we de-risked that element of the scheme. That comprises around 80% of the overall scheme. So it's a mixed-use development. There's a small element of residential in there as well, with 9 affordable apartment units. We acquired this site in November 2017, and we are looking to start building out in the summer, in August, and to complete the overall project in Q1 2022. It's fair to say that you know, a lot of the value add in this project is by identifying the hotel operator very early on, engaging with them, and we think that the operator that we found really sits well alongside the office project. You know, it's a slightly trendy sort of mid-market operator, and provide a good amenity for the office asset as well as vice versa. So it's a very strong development, and we're very pleased to be building this one out. The other angle to the project is that obviously it's very close to Crossrail, which we see as a major, Farringdon being a major Crossrail hub on the Elizabeth line. So, you know, we're very alive to the fact that when we invest in these projects, we're looking for assets that are close to key transport hubs as well. So they'll offer excellent connectivity. So you can see on the image on screen now is on the left is the original Ragged School building, which, as I say, was a former Victorian orphanage. And, you know, we're looking to retain that, optimize the character and the original features of the building. You can see a computer-generated image of the final product on the right-hand side. This is one of the spaces inside the Ragged School, which is a unique assembly hall with a huge, vault ceiling. And again, you can see on the right how we're looking to use that to create some really inspirational workplace and command, you know, hopefully what will be some of the top rents in this market. The next slide here is the hotel building, which is on the Eyre Street Hill side of the site, and this is the ground up new development. So it's an 8-story hotel building, which we're building off a car park. So we've added a huge amount of value there through an underutilized part of the site. And as I say, the office will be completed in the summer of 21 and the hotel in March 22. And we think this is an excellent forward funding opportunity for the institutional market as well. So that's our Clerkenwell scheme. The next project I'll take you through is in Victoria, which is at Greycoat Place. And this is a slightly different type of project, but has many of the the features of Clerkenwell in that it's an underutilized building. It's a building with a lot of historical significance in very close proximity to Victoria Station, which obviously is a major transport hub as well. And we identified this asset last year, so we've owned it for nearly 9 months now, and we can see a great opportunity here from this slightly poorer quality designed facade, and the sort of 1970s features here that really hide the original character of the building. And I'll take you through the images in a minute, but just in terms of headline features, we're looking to create around 75,000 square feet of space from an existing floor space of around 60,000 square feet. So significant additional massing through a two-story extension. Total GDV is 130 million, and we'll be going in for planning in the next month or so to achieve a construction start in the start of next year in Q1 2021. So you can see on the left the original building here, which is a rendered finish over the original brick facade of the Victorian warehouse building. And we're looking to replace that facade back to its original heritage, really, with a red brick and curtain wall system to really max out the original features of the building. Internally, we've got some incredibly impressive exposed brickwork and steel work, which again creates some really inspiring workplaces, and that's exactly what the occupational market at the moment is really looking for. And we see a real differentiation here in Victoria, where there are a lot of new build, I would say glass box type buildings, which have been developed over the last 10 to 15 years. And we've got here a building of significant historical value and scale at the same time, with 10,000 square foot plus floor plates, which is a key threshold now for occupiers and a sort of unique selling point for us. On the top left here, you see the original grey coat Army and Navy warehouse building, which has been then refurbished in the 70s, with the image on the bottom left showing the rendered finish, and then on the right a CGI of the new scheme. So we're adding a lot of value here through maxing out and optimizing the original features of the building, both externally and internally, creating additional massing through the two-story extension. And you can see we've done that very synthetically in terms of surroundings by the cutback there, and it actually, from a street view appears like a very limited increase in scale versus the original building. So it's been designed quite cleverly, sympathetic to its surroundings and other listed buildings in close proximity. And finally, some CGI images of the interior spaces, where we're looking to really create some design-led features, a reception area with a great arrival experience. Lots of exposed brickwork and steel work. We've got some significant steel beams and columns in the building which are currently covered up. We're looking to expose those and really max out the character of the scheme. So we'll be going into start works early next year and completion in the second quarter of 2022. And I would say, both of these projects in London, they're not without their challenges, but we are very confident that by the time these schemes are completed, we'll be through the COVID crisis, and we'll be very well positioned to capture a rebound in confidence and sentiment, both in the investment market and the occupational market. Victoria is historically a very undersupplied market. It's around 3.5% undersupplied, with 3.5% vacancy rate. So, we believe in the core principles of these markets, and it fits with our investment philosophy of investing in strong sub-markets, which we think will capture rebound in confidence in due course.
Simon, thanks for that. I mean, you brought up the aftermath of COVID-19 and the current scenario we find ourselves in. So perhaps the most natural question is getting away from those specific projects. How do you feel have real estate values in London been impacted as a result of the crisis we're currently in?
Well, I think what we're seeing at the moment is that investors and occupiers are adopting a sort of wait and see approach. I think it's too early to see any real corrective pricing. There's certainly not a lot of distressed pricing going on the selling side, and I think the overall market is in a slightly different place to where it was pre the crisis in 2008, and that there's not a lot of supply. Generally, a lot of sub-markets in London are undersupplied versus demand. There hasn't been a significant amount of speculative development pipeline. So, at the moment there is still confidence in London as a long-term centre for real estate. and we haven't seen any corrective pricing. I think what we have seen is a reduction in the volume of buyers in the market. But in these situations, there's generally a flight to quality. So we have seen transactions concluding in the last couple of weeks at some 4% yield still on the better quality assets. And investors generally go for income-led schemes and back to very strong underlying real estate submarkets where they believe in the long term, and that there inevitably will be some fallout occupationally to come, and there'll inevitably a yield gap between prime and secondary. But we're not seeing any significant seismic shifts in pricing or investor or occupier sentiment. It's generally a let's sit back and wait and see. But there are investors, including us, that are looking to take advantage of the reduction in volume of buyers in the market and actually achieve some more sensible pricing.
Can we just explore the reaction of investors and occupiers that you brought up there in a little bit more detail, how you've seen investors and occupiers reacting to the current scenario?
Yeah, I mean, in terms of investors, obviously, overseas buyers, generally for logistical reasons and the inability to travel, they can't physically go and see the assets. So they've generally stepped away from the market. Quite a lot of UK institutions have come out of the market. Their investment committees inevitably, adopt a cautious approach in these markets. But there are still buyers out there. There are European institutions. There's money from Asia. And London attracts such a global spread of investor, global spread of investors. It's a very diverse investor base. So it means that, whilst a number of investor types can fall away from the market, there'll be others to step in. As I highlight, there are transactions still being concluded in the last 2 to 3 weeks at very, very strong pricing levels. So it's not a total fallout. It's definitely a reduction in volume. In terms of occupiers, I think we've definitely seen that at the smaller end of the market, so smaller floor plates, where occupiers are a bit more fleet of foot, there generally has been a slowdown, and occupiers are definitely stepping away from the market. But the more structurally led requirements, bigger requirements which have been planned for a long time and which relate to sort of a big strategic piece going on within these corporations, they're still going ahead. And I've got some statistics here which out of around 47 sort of key leasing transactions in central London, only 3 of those have been totally withdrawn. 36 out of those are still under offer. If they were under offer before COVID, they remained under offer, albeit that they've slowed down slightly. And 5 out of those 47 have completed in the last couple of weeks. So, the majority, about 75% of those 47 deals that were going through pre-COVID are still going through, and a very small percentage, around 7%, have been withdrawn entirely. And these are, I'd say, at sort of 20,000 square feet and upwards transactions in the central London leasing market. So we haven't seen that sort of shock. We've seen a slowdown. We've seen a rebalancing, and sort of people taking stock of the situation. And generally, as I say, I think in terms of prime availability of office space, there isn't a huge amount out there. There will be an increase we think, in the grey space in terms of tenants releasing their own space, but that will be, it will be second-hand space, so it won't be of the same quality as newly refurbished buildings.
Opportunities coming out of this scenario, if you can talk to the London market, Simon, and where you are seeing potential opportunity.
Yeah, I think it goes back to my earlier comments about taking advantage of the reduction in volume of competing bidders. And we bid on a couple of assets in the last few weeks, which are in very strong submarkets. They're slightly on the smaller end, and these are sort of, I'd say, more quick asset management led deals where we can hold for 2 to 3 years. Where previously there was an enormous pool of interest and bidders chasing these assets. 90% of which have fallen away, and we can now almost get an exclusive position on them, because we've got our teams on the ground, we've got our experts and consultant network who can react very quickly to these opportunities in terms of advice, in terms of pre-acquisition surveys, provided they're within the limitations of the distancing restrictions. We can still buy real estate in this market, and we're taking advantage of that reduction in volume of bidders. There is one asset in particular which was where the pricing was being forced up beyond quoting levels, and is now, we believe we can acquire it below the quoting price because there isn't that upward pressure. So we're taking advantage. We're looking at a building in St James's. We're looking at one in King's Cross at the moment as well, both of which we bid on in the last couple of weeks. So we are still active. We're still looking to seize the opportunity of some of the situation with COVID.
Simon, thank you for that. From London, we're going to hop across the channel and join Olivier Hezelot in France. Olivier is locked down there at the moment, but he is very much involved in the management of the Portuguese-based assets. He's head of real estate in Lisbon for GMG Real Estate. And Olivier, as we did with Simon, first of all, a very warm welcome to you, but also if you can just take us through the current flagship projects for GMG Real Estate in Portugal.
Sure. Thank you, Matthew, and good morning to everybody. So in terms of flagship project, I'd like to present you our Helix Living project. Maybe let me share this screen. So this Helix Living project in Lisbon is a residential development project in the prime CBD area of Lisbon. So extremely well located, close to the main avenue, which is called Avenida da Liberdade, which is the Champs-Élysées of Lisbon. So very prime location for this project. So the project consists in 150 high-quality apartments, most of them with terraces and balconies, which is not common at all in Lisbon. We are selling the small apartments fully furnished with a 3-year rental guarantee. The gross development value of this project is around 96 million euros. So it's quite a sizable project. So we acquired this building in June last year. And as of today, so more or less 10 months after acquisition, we already sold off-plan 104 apartments out of 150, which means that more or less 70% of the project is already de-risked and has been sold off-plan. So far, we've performed already all the demolition, so we've cleaned all the site, and about to start the digging and the construction per se within the next few weeks. In terms of expertise, I would say that GMG, together with his local partner, John Raby, we brought our expertise in terms of apartment design and also layout efficiency, which is extremely important for such a residential project. For instance, we acquired the building, the project with an existing construction permit in place. But we decided to modify this original construction permit so as to create, I would say, more efficient apartment layout, and we've redistributed the typologies of apartments in order to better fit with the market demand. And therefore, we've reached a point where we offered a very attractive price versus number of bedrooms per apartment. We also brought a lot of experience in terms of marketing and sales strategy, especially via our international network. we've implemented a very proactive and innovative sales strategy, which was not really common on the Portuguese market, which was more, I would say, traditional. And for example, we've hosted a very large launch event together in South Africa and in Lisbon. And we've also built an on-site marketing suite with a showroom apartment and also interactive 3D virtual visits of the different apartments. So you'll see on the screen the quality we are looking or we are proposing to our buyers. You'll see on the top right or left corner, we'll have rooftop swimming pools. On the other images, you'll see the apartments have been designed with very large bay windows and also large balconies and terraces.
I must say, I was privileged to be at that launch in Lisbon, Olivier, and the virtual reality tours of the apartments, quite something, and an excellent site as well. So we look forward to the ongoing developments there. As I did with Simon, perhaps you could give us some commentary, though, on how real estate values in Lisbon in particular have been impacted as a result of where we find ourselves today.
Yeah, sure. So I would say the situation is quite similar to the one in London, in the sense that so far no significant drop of prices have been seen on the Portuguese market, especially on the Lisbon market. I would say most of the players, so both from the buyer and the seller side, they are all on the wait and see mode, if I can say that. And they're all waiting to evaluate the real impact of this pandemic on the real estate sector. On the residential sector, no major impact is expected since the demand still largely overcome the supply. So we still have this structural mismatch between supply of good quality apartments and demand for this type of good quality apartments. On the office sector, the situation is slightly different, and we are seeing expecting a long-term structural modification, but I would say which would be the same on all the different regions, mainly due to the fact that now the work from home policy have proven to be efficient for several companies, and they will probably continue on this trend and will probably reduce their requirements in terms of office spaces requirements. For example, according to CBRE and their most recent market research, they expect the office cap rate to be increased by 50 basis points in the short term. So meaning a price decrease in the short term, slight price decrease. But also what we are seeing, again, very similar to the London market, is that there's still a large amount of capital available. So on the hotel and retail sector, market values are expected to be affected, but a significant amount of institutional and international players are lining up to seize these opportunities. So what we are expecting actually is that this large amount of capital may imply quite a significant competition for this type of distressed, if I can say, distressed opportunities, and this could actually offset the price decrease. So overall, the price may not fall very sharply. Then also a last point regarding Portugal in particular is that, as most of you may already know, Portugal has been ranked as the third safest country in the world. So the country's image as a peaceful and open society will probably continue to attract visitors and investors. thanks to its, I would say, efficient management of the pandemic, Portugal has managed basically to maintain a relatively low rate of COVID infections. So this will probably enhance the vision of Portugal as a very safe place, where the health system is strong and where tourists and retired people can expect a very high health and safety standards.
Olivier, perhaps where you are seeing opportunities in the Lisbon market. I mean, you've spoken a little bit about it. You say there's large amounts of capital available, but what do you see as the major opportunities in your particular market?
Yeah, so in our particular market, we're seeing, I would say, two type of opportunities. I would say the first one would come from distressed developers. I would say that whilst the banks the Portuguese banks are still lending, we expect them to be more selective on their lending activity and really concentrate their relationship with existing strong developers who have a proven track record and really strong financial strength, which are clearly GMG's case. So we are already seeing some opportunities of joint venture developments with local developers who would bring basically their land to the partnership, and GMG would bring the funds and also the expertise and the relationship with the banks to move forward with the development. The other angle that we are seeing is on the non-performing loans from the banks. The banks already started this process, but we already expect with this crisis, we expect the Portuguese banks to even further accelerate the if I can say the unloading of non-performing loans from their books, and really to clean up their balance sheet even further.
Olivier, perhaps one last question for you, though, and something that's attracted a lot of attention, certainly out here in South Africa, the Golden Visa program, which is linked to property investment. Can you give us an update on where the Golden Visa program is right now, whether there's been any change?
So there's been a lot of noise regarding the Golden Visa, and I would say that Golden Visa is still alive. Indeed, whilst the government approved to modify and restrict the Golden Visa program prior to the pandemic, no formal action has been taken so far, which means that no decree has been voted, and the Golden Visa remains as it was before. So there's been a lot of noise in the newspaper, a lot of things have been discussed, but no action really has been taken, and Golden Visa continues as it was before. On top of that, I would say that because of this situation with the COVID impact, the potential impact on the economy, I would say that no changes of Golden Visa are expected. As I said, due to the impact on the COVID on the economy, it is extremely unlikely that the government would take any measure against the Golden Visa program, which as a reminder, contributed after the 2011 international bailout to the strong recovery of the Portuguese nation. So the market consensus is clear about the fact that the government will not modify the Golden Visa program, at least on the short or to midterm, so as to avoid any negative impact on the economy post crisis.
Olivier, thank you very much for that update from the project in Lisbon and the effect of the market in Portugal. We're going to flick back to London now to join the newest member of the GMG real estate team, Matthew Card, who's an investment analyst. And Matthew's going to share with us some of the more macro factors around lending markets and so on. And Matthew, perhaps if you could start with the current state of the UK lending market.
Sure. And good morning. Thanks for having me. It's a pleasure to be here. And good morning to everyone online. So it's no doubt that since the start of the crisis, there has been a general slowdown in the lending market. And this is due to a few major reasons. The first is that underwriting in general has become far more challenging. So the lack of recent transaction activity, uncertainty on future economic projections, and just the physical limitations of not being able to conduct valuations has certainly limited the ability for price discovery of any asset. And with lockdown and remote working enforced, you also have a reduced availability of professional services such as lawyers, quantity surveyors, and valuers, which is sure to create some delay in the entire process. It was seen in an interview recently with one lender where they suggested that what was a short time frame of 1 month could easily now be double that. And there's also greater uncertainty in the lender funding costs and margin returns. So all the recent capital market volatility that we've seen in rates, and as well as the lack of liquidity in the CMBS markets, it's made calculating the true costs of funding for lenders quite difficult. And there's also less certainty about future cash flow sustainability, which makes pricing the adequate compensation to cover the increased risks quite difficult. So what this means is that lenders are focusing inwards on their existing clients. So it's expected that non-payment of rent and vacancy rates will certainly increase over the short to medium term. And it's estimated that there's about 43 billion in loans maturing by 2021, and a number of these are expected to default. So traditional lenders, your retail banks, your high street banks, pension and insurance providers, they have these large legacy loan books, and they'll most likely be focusing on supporting their existing clients to try and minimize the level of defaults and non-performing loans hitting their balance sheets. But also the sentiment in the market between existing lender-borrower relationships seems to be quite positive, with many lenders supporting their borrowers with some form of covenant leniency. But there's also been no desire by these lenders to enforce on any of their loans. And this is either due to the practical difficulties due to COVID or the reputational cost of doing so.
And from what you've seen, Matthew, has the increased uncertainty impacted lending terms for new loans?
Well, it certainly has. Most lenders now are retrenching to their core business strategies. So they're focusing their attention on high quality assets such as prime office, residential, student accommodation, and these are all in central London boroughs. Those lenders who are looking to do new business will most likely review their leverage levels downwards to account for the possibility of asset values falling. So in one recent study at the end of 2019, on average, UK banks and UK debt funds were offering maximum loan to values of 65% and 75% respectively. But it's expected that for the majority of these lenders, these could fall as much as 5% in the short term. But also margins will most likely increase as well in the short term to cover the increased risk in the funding uncertainty. But as the leverage levels decrease, there will be an opportunity for many alternative lenders and mezzanine providers who are far more flexible in their risk appetite. And in such cases, these lenders will adapt, they will update their lending strategies to take advantage of these opportunities. So while they're working within the constraints of their funding.
And a key question in a number of different markets, but perhaps, if you could comment on the UK, how is government supporting the market?
Well, from an economic perspective, the UK government has reacted quite quickly to the crisis. It's indicated that it will offer close to 250 billion in funding initiatives to slow the impact and maintain confidence in the market. That's their primary goal, is to slow the impact and just maintain the confidence. And for instance, a number of economic schemes, including the Coronavirus Job Retention Scheme, the COVID-19 Corporate Financing Facility, and many types of mortgage payment holidays, they've been enacted to support borrowers in meeting their short-term rental obligations. And this is all done to just maintain liquidity in the market.
So if we move from macro to slightly more micro issues and focus back on GMG real estate, how do you believe that the company is positioned to withstand the crisis that we're currently in?
I mean, I think GMG is positioned quite well to withstand the crisis. It has a resilient core business strategy. GMG's business is focused on short-term value-add developments in quality assets and prime locations throughout London and Lisbon. And as Olivia and Simon alluded to, these are considered safe havens in the current climate. GMG also has quite robust relationships with equity partners, and it has a significant access to capital. And this means that GMG has far less reliance on traditional debt finance than many other developers out there. I'll just share with you my screen quickly. Across the 4 portfolios around the world, we have a current loan-to-cost ratio of 51%. And if we look forward, we can see that the loan-to-value aggregated across all 4 portfolios does not exceed 50%. What this means is, again, that we don't have that reliance on the traditional debt finance. So in my view, investors and developers such as GMG, who are well capitalized, have lower reliance on leverage, have invested in quality assets and have experienced management, will not only be able to navigate the economic crisis, but will be able to take advantage of any opportunities that are presented.
We've seen from your colleagues some of the opportunities that they are seeing in their respective markets. I'm going to come back to Newman in just a moment for some closing remarks, but I'm going to ask Ross if we can perhaps share the poll that was which you were asked to participate in. How long will it take for debt markets to return to pre-COVID levels of liquidity? So it's very clear that a dramatic minority think it's 6 months. The majority vote is around the 18-month mark. Perhaps I can throw it to our GMG real estate team. Newman, Simon, Matthew, perhaps you'd like to take this one. What do you think? You weren't allowed to vote in the poll, but do you concur with the majority that perhaps 18 months is the number?
Yeah, I think so. I mean, from my side, I think, I can see the sentiment in debt markets sort of lagging behind, I suppose, investor sentiment. It's normally, occupational sentiment, then investor sentiment, and then debt market sentiment, I think probably in that order from where I'm sitting. So I do see it taking 12 to 18 months to see a proper recovery.
Well, thank you to those of you who gave your votes in the poll. Also, thank you to those who've shared questions. And I think as I've tried to look through some of the questions that have been coming in, we've definitely covered a large proportion of those questions in some form or other. But as we have done with previous webinars, please do be assured that we will get members of the team to answer those questions that haven't been specifically answered. So as promised, back to Newman to close up for us. I mean, Newman, we've had a quick whip around the houses. It's strange in these webinars. You think you can keep them nice and concise, but there's so much information to digest, and quite difficult to sum up the extent of your business operations in a relatively short space of time. But we've had an introduction to various members of the team, the current state of play across your portfolio, what the opportunities look like. We've looked at some of the macro factors, and perhaps you could just share some remarks in summary around how you feel you are positioned going forward.
Thanks, mate. Yes, I mean, we also didn't touch in the panel or deal with our flagship asset in Switzerland, which would have taken further time. But suffice to say, we are developing one of the quite a large 45,000 square meter development in downtown, not downtown, but just outside of Geneva in an area called Satigny, which is the prime industrial area of Geneva, just next to the airport, and on the border between France and Switzerland. So that's another big project that we didn't actually touch on. But as to our outlook and going forward, I firmly believe that GMG Real Estate are operating from a position of strength for 2020 and beyond. As my colleagues mentioned, we have some really strong real estate fundamentals within markets in which GMG are invested in. We have very low exposure to speculative vacancy risk in the short term. We've got one asset with a big covenant. We own the assets, the corporate headquarters of IBM in Stuttgart, Germany, and I believe they'll continue paying the rent. We have low gearing across the portfolio, as Matt mentioned. And most fundamentally, we have good quality assets in the portfolio, and a flight to quality will definitely play into our hands over the next period. In 2020, we'll continue to successfully execute our business plans across the projects and maintain a clear focus to de-risk the assets by way of securing a sale or refinance at the appropriate time. And in addition, we'll keep probing the markets to seek unique opportunities, distressed deals at a substantial discount to market prices.
Well, Newman, that's a pretty succinct summary of what we heard. We thank you for that, and thank you for the ongoing partnership that you enjoy. I think what's been clear in these last 6 weeks, where most of us have been locked down, certainly not locked up, but locked down, is the strengthening of business relationships and business partnerships, and a coming together of the various teams across counterparty relationships as well. And what has been clear is that you and your team have an attention to detail which is to be admired. So I'd like to thank you all for your input. Olivia, Simon, Matthew, Newman, we really appreciate your time today and the opportunity for you to share with us some of what you're busy with and some of what your future looks like. So a huge thank you to the GMG Real Estate team, and I'm going to hand over to our Skybound Capital Chairman, Cliff Warren, to just say a few words in closing. Cliff, thank you.
Thank you, Matt. We value the relationship with GMG Real Estate. We value the relationship more than anything that we've got. We regard the asset class as significant in our book, and I'm very impressed with the level of reporting, financial discipline that they've displayed, not in the past, but in the present and in the future. That's been a very valuable asset for us to have access to. So thank you, Newman, and thanks to you all for attending.
Awesome. Well, thank you so much, Cliff. And it's lovely to be back in the office with you and Matt. And we look forward to seeing more and more staff as they start to make their way back into the office. But a huge thank you to all our panelists. It's so wonderful to be connected in South Africa, but all over the world. It's really, really great to see you all and to meet you and to hear more about you. And a huge thank you to Ross, who always is working extremely hard behind the scenes, making sure that everything runs smoothly. So a huge thank you to Ross. And for all of you who would like to sort of have a look at the webinars that have been shared with Skybound, if you go to our website and click on the Media and Insights tab at the top, you will see the recordings all being loaded on there as soon as they're ready. So please go and have a look. But thank you so much to everyone in the world for joining us, and we hope that you have a great rest of the week ahead. Thank you so much.